The Australian Financial Review.
Well, Lisa, it was a Friday. I was coming to work probably a bit later than I probably should have. And as I was making my way to my desk, Jessica Sire, our tech reporter, leapt in front of me and just said, "John, Silicon Valley Bank."
That's my colleague, Jonathan Shapiro, who writes about banking and finance for the Australian Financial Review. On Friday, March 10, he found himself writing about a US bank he'd never heard of.
It was like a collision between the crashes in the bond market and the problems in venture capital. We got really excited and we started writing about it, but we had no idea what a big deal it was until perhaps later that day when we'd seen how the Australian bank stocks had been hit so hard. Like they were down 3 or 4%, which is quite unusual. And that was the first sense that we appreciated there was an element of contagion here.
They were right. The banking crisis did spread all the way to Europe.
And then over a week later, Monday morning, 7 a.m, we got this email about a press conference for UBS and Credit Suisse.
Ladies and gentlemen, I am pleased to be here today as we announce this integration, one that reinforces Switzerland as a leading global financial centre.
7 a.m, we dialed onto the call on my way to a bond conference, actually.
Let me be very specific on this. UBS intends to downsize Credit Suisse's investment banking business and align it with our conservative risk culture.
And some of the information in there, including bond wipeouts and all that stuff, was quite dramatic. And I just knew there and then I probably wouldn't see my kids until Friday.
We're well aware that in the coming weeks and months will be difficult for many, especially for the employees. Let me reassure you that we will do our utmost to keep this time of uncertainty as short as possible.
Welcome to The Fin. I'm Lisa Murray. Today, senior reporter Jonathan Shapiro on how the latest financial crisis spread across the globe, what Australian banks and regulators are doing about it, and where the next fire might start. It's Thursday, March 30. Johnny, the global financial crisis in 2008 took 18 months to roll out and was followed by over a decade of banking sector reform. But this latest crisis has happened despite those reforms and at lightning speed. Tell us about the conditions that led to the turmoil in the global banking system over the past 3 weeks.
Well, Lisa, there's two preconditions and they relate to the digital age, and that is that news travels fast through social media, but money also travels fast. So just a few clicks of a mouse and millions, if not billions of dollars can leave one bank account and go into another. So we're dealing with the potential for bank runs on a magnitude and scale and speed that we've never seen before. The other thing, Lisa, that has manifested this banking crisis is the very rapid rise in interest rates over the last 6 to 8 months. So a lot of banks have invested in government bonds. A government bond is effectively money that the government has borrowed. Now, while we might borrow money in the form of a loan, a government or a company issues bonds which are tradable loans effectively. And they're issued at a certain interest rate, and through the life of that bond, as interest rates change, the price of that bond changes. Now, those government bonds have lost value not because people are worried that the government won't pay them back, but because those government bonds were issued or bought at the wrong price. So if you bought a government bond a year or two ago at 1%, now that government bond is 4 or 5%, that bond is not worth the same price because you can buy a bond now getting a much higher interest rate. So what that has meant is that the value of government bonds have fallen quite significantly, about 5 to 10%, which is a lot for something that you think is safe. Now, the reason that matters for banks is the banks have taken a lot of the money they've got from depositors over the last 2 years and invested in government bonds to earn an interest margin. But now they're nursing losses. And now that those depositors want their money back, the government bonds that they've bought with those deposits aren't worth what they were when they got that deposit money in. Now, as interest rates were rising, there was no bank on earth that was more exposed to this than Silicon Valley Bank.
So as you've mentioned, bad news and money travels fast these days, and that's what turbocharged the bank run at Silicon Valley Bank and provided the trigger for the latest banking crisis. Talk us through what happened there.
Silicon Valley Bank it's a fascinating situation.
We are back now with breaking business news. Federal
major
regulators
development in the banking world. The FDIC just reported that
SVB, the 16th largest bank in the U.S. with $175 billion in deposits, is now the biggest American bank to fail since the 2008 financial crisis.
And it really is a pincer of two megatrends that we've seen accelerate over the last 12 to 18 months. One of them is what we've spoken about, is that interest rates have increased rapidly.
Mm-hmm.
The other, which is related, is that since interest rates have increased greatly, one of the big boom areas of the last couple of years, venture capital, is now in a bust period. So Silicon Valley Bank was the banker to startups. They went and courted a lot of business from venture capital funds and their portfolio companies that banked with Silicon Valley Bank. So every time a startup raised money, they would deposit the cash into a Silicon Valley Bank account.
Mm-hmm.
So long as startups were raising money, money was in Silicon Valley's bank accounts.
Mm-hmm.
But everything sort of changed when interest rates went up. So when interest rates were zero, investors were quite happy to take these moonshot bets on startups because, their money was earning zero in a bank. So they were happy to take a 10-year bet that this company would overtake a certain industry. So low interest rates afforded them patience. But as interest rates went up quickly, that patience evaporated very quickly. And what that meant was Silicon Valley's bank's deposit base gradually eroded to the point where they sort of had to finance these deposits by getting rid of some of these assets that they owned. And the assets that they owned were these government bonds that had lost value. And it all came to a head in mid-March when the bank sort of felt they had to act on this. So they hired Goldman Sachs to sell some of their bonds that were at a loss and then raise $2 billion to sort of plug the hole that the losses would have created. And that's what triggered the bank run. There was a loss of confidence, and customers of Silicon Valley Bank pulled out an extraordinary $42 billion from the bank within a 24-hour period. So as the Silicon Valley Bank collapse caused a full-blown loss of confidence in the US banking system, it didn't take much for that crisis to jump across the pond. And when it did, it had Credit Suisse in its sights.
So, John, the problems at Credit Suisse didn't just emerge recently. The global investment banking giant has been struggling with a series of scandals and reputational issues since last year. Tell us about the crisis of confidence that led to the bank's dramatic rescue this month.
So to understand the issues at Credit Suisse, it might be actually worth going back to the GFC. So Switzerland is the home of banks, and the two biggest banks in Switzerland are UBS and Credit Suisse. Now, UBS had a terrible global financial crisis. They nearly went under. They got in over their skis on mortgage-backed securities. And ever since then, there's been a fixing up of the bank to change their risk culture, to move away from risky investment banking and trading and be more of a wealth manager, which is why they were set up. Credit Suisse sailed through the global financial crisis in relatively good shape. But ironically, 12 years later, it's Credit Suisse that are in trouble. So they didn't have the comeuppance that UBS had, and they didn't get their risk under control. And they've made a series of very risky, bad decisions that have blown holes in their capital base. So they were on the wrong end of a big secretive US hedge fund that was using a lot of leverage to make bets on very speculative companies. And that hedge fund collapsed, and all the Wall Street banks did margin calls, and Credit Suisse was the last to sort of get their money out. So it took a huge loss without having made much money from servicing this client. Then they were also involved in Greensill, which a lot of Australians might know a lot about. It was a supply chain financing company that collapsed and has been in the courts, and there's lots of controversy about how did they finance themselves and who did they finance. And Credit Suisse also took a hit there in terms of their capital base. So the crisis of confidence in Credit Suisse took a leg up in October when an Australian journalist from the ABC made this very suggestive tweet about an investment bank being on the brink. And that whole weekend in October, there was real sort of panic and fear about the health of Credit Suisse, and quite a lot of deposits left the bank over that weekend. Fortunately, they were prepared in terms of having to have, regulatory assets available to sell, so they met those deposits. But if you take the Credit Suisse leadership at their word, ever since that moment, it's been a battle for them to maintain confidence in the bank and maintain the trust of depositors. And things really didn't get better for Credit Suisse. In February, they had an enormous $120 billion of deposits leaving the bank. And in an environment of global unease about the banks, which the Silicon Valley collapse caused, Credit Suisse became very, very vulnerable to a further loss of trust and a fatal loss of trust.
Mm-hmm.
Now, the Saudi National Bank had put in almost a 10% stake in the bank, and they were nursing losses as the shares continued to fall. And then that culminated in comments from the Saudi bank on March the 15th, which really rattled the market.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons.
And those comments were that the Saudis would not be investing any more money into Credit Suisse.
So that comment from the Saudi National Bank chairman triggered investor panic, sending Credit Suisse shares plummeting even further. Then what happened?
So the headlines started to emerge that the Swiss regulators were determined to see Credit Suisse taken over by UBS, which was now the much larger, more powerful, stronger institution.
Overnight, banking giant UBS acquiring its embattled smaller rival, Credit Suisse.
Credit Suisse was bought by fellow Swiss bank, UBS, after a deal brokered by the Swiss government.
Officials have been racing to rescue the 167-year-old bank, among the world's largest wealth managers, after a brutal last week saw two U.S. lenders, Silicon Valley Bank and Signature Bank, collapse.
And the motivation was to restore faith in the Swiss banking system, to put an end to any fears of Credit Suisse's solvency, and UBS was seen as the natural partner. But it wasn't an easy deal to get over the line. It would normally require shareholders to approve this deal, but they didn't have time for that. And it was debatable as to whether shareholders would approve this deal on both sides. UBS had spent the last decade cleaning themselves up, and Credit Suisse shareholders wouldn't exactly be rushing to vote for their own demise. So Swiss regulators had to nut something out. And what they did was interesting, but extremely controversial.
Mm-hmm.
They needed to ensure that UBS shareholders wouldn't be on the hook for potential losses that they weren't aware of or that might emerge. And one of the ways to solve that was to basically wipe out the junior bondholders, is probably a good way to describe them, of Credit Suisse. So these junior bondholders or additional Tier 1 capital holders, we call them hybrids in Australia, had about $17 billion of securities tied to Credit Suisse. They're called hybrids because they're half debt, half equity. So they look like debt in that you get a fixed interest payment regularly, but they're like equity in that when things go wrong, the bank or the regulator can treat it like equity, which means it can stop the dividend payment, it can convert it to shares, or it can wipe out the value of it to protect depositors. And with a stroke of the pen, all that money was zeroed.
So just to be clear, Johnny, those investors ended up with nothing.
Zero. And that's when a move that one might have thought would restore faith in the global banking system actually had the effect of doing the total opposite. And the reason why is because those Tier 1 securities or hybrids are effectively an insurance against the banking system. But when Swiss regulators rather controversially decided to wipe that out, it created a bit of fear in that market for those Tier 1 securities that, wow, like if this can happen to Credit Suisse hybrid investors, this can happen to hybrid investors of any bank. So when you're buying a fixed income instrument, you're pretty much relying on getting your money back because you're only getting an interest rate. So you don't feel like you're taking excessive risk. So a loss on something like that is felt a lot more than a loss on an equity where you're taking risk. This investors didn't really appreciate or think that they were taking as much risk to the point where they could lose everything. And that immediately rippled through to the market. So banks like HSBC and Macquarie, their Tier 1 bonds traded in the market and they were falling by 5-10%. So there was definitely a lot of concern about, well, if banks can't raise this kind of capital, can they raise equity capital and can they raise any capital and at what price? So all on Monday, after the deal was done, the focus was not on how the Swiss regulators had fixed the problem. It was on the other problem they'd just created. So fortunately, other central banks, the Bank of England and the European Central Bank, were very quick to sort of put out statements along the lines of like, don't expect this to happen at banks that we regulate. We'll be a lot more discerning in the decisions we make in terms of wiping out bondholders. So that sort of alleviated some concerns, but it just showed how a banking crisis, there was no circuit breakers or firewalls. The banking crisis kept finding a new thing to be concerned about, and this was just yet another one. So, Lisa, what does this mean for Australia? Our banking system is really strong, and everyone has been very quick to point that out. But it does have weaknesses, and I don't think anyone should be complacent when we've seen a Swiss bank fail.
So, Johnny, let's talk about what this means for Australia. You just said we shouldn't be complacent when a Swiss bank fails. How well prepared is our financial system if this contagion were to spread or cause a crisis of confidence here?
Well, Lisa, there's a lot that is working in favour of our banking system. Not only did we survive the global financial crisis, but we weren't that complacent after it. We had a series of reviews into the conduct and culture and the capital of the banking system. David Murray, the former CEO of Commonwealth Bank, did a review in 2014 and said that our banking system needed to be unquestionably strong. So whatever we were doing then, we're now doing more of now. So there's a lot of reasons to have a lot of faith in the banking system. The main issue for both Silicon Valley Bank and Credit Suisse wasn't that they didn't have enough capital or they had written a lot of bad loans. It was that there was a very rapid flight of deposits. Now, Australia's banking system is actually short of deposits. We raise a lot of money from the wholesale market, and that's where this crisis could have effects. You know, our banks have to go overseas to raise about 20% of their funding from overseas investors. And if overseas investors don't get the nuances of how healthy our banking system is, they just see banking risk going up. So they'll charge our banks more to raise money, and that could have margin impacts for for the banks and could flow through to mortgages. But I guess the more pertinent thing is, could there be a banking run on Australian banks? Could depositors run? And I think most people would agree that it's almost not possible. There's nowhere for an Australian household to take their money and put it other than under the mattress or in a gold bar. And most Australians would much rather take the risk of leaving the money in a deposit than doing something else with it. So we do have a sort of self-contained deposit system. The question is whether the banks themselves are fighting each other for that pool of deposits. So if a bank experiences a loss of deposits or needs more deposits, they'll have to pay for them, and that could lead to deposits flying around. And that actually brings another point of what we've seen overseas in the banking crisis or the banking weakness, which we haven't discussed, which is that while some banking deposits have left their banks because of concerns about the health of the bank, the biggest reason why money is leaving US banks is because the banks just aren't paying an attractive deposit rate. So when the US Fed has been raising interest rates from 0, 1, 2, 3, 4, and now 5%, a deposit doesn't pay that much. So a lot of Americans are moving their money into what we call money market funds, where you effectively can earn the government rate. And they're as safe as a bank deposit because you're effectively putting money in a fund that lends the US government for short term. Now, we don't have that now in Australia. So our deposits aren't going to leave for that high interest rate because they can't get that. So we're almost beholden to the banks. So between that and the banks being able to reprice their mortgages, yes, our banking system is safe and rock solid, but we're paying for that. We're paying in the form of not getting the right deposit rate or, not being able to earn the RBA cash rate with ease and potentially being vulnerable to repricing if the banks have to pay more for their wholesale deposits. So, yeah, we can take some comfort that our banking system is solid, but we shouldn't forget that we're bearing the cost of it.
So, John, you went to the AFR Banking Summit on Tuesday, and many of the top bank CEOs and regulators were there, and some of them spoke. What's been their response to the crisis?
Well, Lisa, the conference was a real show of force about how strong and resilient our banking system is. So we had Matt Common from the Commonwealth Bank saying that our banks are amongst the best capitalised in the world.
Well capitalised large bank in the world. I think the 4 Aussie majors would be 4 of the top 5. We're holding sort of pre-GFC, or relative to GFC, 2.5 times more capital, even after we scale the balance sheet for growth over that time.
Westpac CEO Peter King was also there. He said how domestically focused the Australian banks were and how that stood them in good stead.
For the Australian banks, we have a lot of liquid assets, government liquid assets, but we hedge them back to variables. So, that's not an issue that I see in Australia for the system.
But Lisa, perhaps the most compelling case for the strength of the Australian banks was from our prudential regulator, John Lonsdale. he revealed results of a stress test that APRA had conducted.
We hope the day never arrives when the type of dire scenario used for our banking stress tests eventuates.
Which explored how durable the banks would be if unemployment rose to 11%, if house prices fell 40%, if GDP fell 4%.
But should it do so, Australians can be confident in two things. First, their banking system is among the strongest and most resilient in the world.
And if there was, just to add an extra twist, a cyber attack.
And second, APRA will continue to work hard before any crisis and take decisive action to continue protecting deposits, insurance policyholders and superannuation members.
And he said, look, the banks would take a hit and they would cut their dividends, but ultimately there would be enough capital to protect depositors. So he took a lot of comfort from that, and that was why he felt that Australia's banks and our depositors, which are me and you, should feel very safe that our money is in an Australian bank. Yes, so Lisa, while our banking system is solid, and it's proved to be, we should heed the lessons of what we've seen overseas. And while the crisis overseas occurred in the banks, we should be mindful of what the crisis was. And essentially it was a crisis of what bankers call a liability mismatch, where people can get their money out on short notice, but the assets that backs those liabilities have questions around it. And when someone needs their money out, that asset value has to be proven because that asset has to be sold. So there are certain instances where we do see that. There's been a huge growth in private assets and private credit funds, so we might see issues there. And obviously the elephant in the room is our superannuation system.
So let's talk about super. We've been talking about a lack of confidence that leads to a bank run. But do you think there's also a risk that what's happening with rapidly rising rates and how that's changing valuations of assets could also have an impact on super funds?
I think there could very well be a translation from what we've seen overseas into our super funds. And just to be clear, not suggesting that our super funds are vulnerable or anything like that, but we have to recognise that those liability mismatches that we've seen overseas can easily occur in our superannuation system because of the way our superannuation system is set up, in which myself or you can decide today that you want to take your money out of your super fund, and that super fund has to honour that price. But the assets in that super fund are not easily saleable at the valuation that they represented at. So that, as we all know, there are a lot of super funds have invested in private assets, so commercial property, private equity funds, private credit, infrastructure. And those assets are valued relatively infrequently, using models. So they haven't always been tested in the open market where someone's had to sell that asset. So the other problem is when the values of those assets don't change and the value of assets in public markets change quite rapidly, like if there's a huge correction in the equity market, it means all things being equal, that super members' exposure to private assets has gone up. So there's a dilemma for super funds.
So let's just explain that. So if a super fund invests in shares on the stock market and we can see what those shares are valued at every day, and the value of those shares goes down, all of a sudden the unlisted assets is a bigger proportion of the fund, but we don't exactly know what the value is on a day-to-day basis.
Exactly. So that means that member has increased their exposure to private assets. And the way super funds have been dealing with this is to just simply invest more into public markets until they're happy with the ratio again. But that again might have costs. They might be investing in the wrong assets at the wrong time. So I wouldn't say the super funds are at risk of a crisis, but we should be cognizant, and regulators and super funds should be cognizant, and I think that they are, that the system does have vulnerabilities.
So, John, there's been a lot of speculation about what might be the next domino to fall overseas. How do you think this will play out, and how will Australia's financial system emerge from the turmoil of recent weeks?
Well, Lisa, I think we've still got quite a lot to play out in Australia. There's been a lot of interest rate increases here as well, and the full effects have yet to be felt in the economy and the banking system. So I think there's an element of wait and see there. But Lisa, one thing I would say that sort of goes beyond the banking system, and I'm not the only one to speculate on this, is concerns in the private assets or shadow lending sector. Now, one of the consequences of the last 10 years of really stringent regulation that's aimed specifically at making banks safer and making it less likely that taxpayers would have to bail out the banks is that a lot of risky lending activity has migrated from the banking sector into the shadows and into private assets. Now, a lot of the operators in the space are experienced and they've been through many cycles, but I think it's also attracted a lot of opportunists to the sector. And as interest rates go higher and as losses mount, we might find that some of the values of those assets that have been lent against might be tested. And it really is an unknown. We just don't know how much money's been lent, how much money's at risk, and how systemic an issue in that part of the market might be. So, Lisa, this is a bit of an unknown that lurks in the shadows, and we don't know what's been bought and sold at the wrong price. And while we all expected that this massive increase in interest rates would break things in our financial system, we've got to be mindful that this could happen inside the banking sector and perhaps spread well outside of it. In Europe, after the UBS Credit Suisse affair, it seems like the market is going from village to village looking for the weakest link. Deutsche Bank seemed to be in the market sights, but that has abated to some degree. And in the US, I don't think this is quite over yet. There are still a lot of concerns about the regional banks for two reasons. One is that they have a large exposure to commercial property and real estate, and there's a concern about the value of those assets. And the other problem for the regional banks is that they have a lot of uninsured deposits. So just like in Australia where we have a $250,000 government guarantee, the same applies in the US. And there's concerns about how jumpy and flighty those deposits are, those regional banks, and where they might go. So there's still a lot of concerns that need to be addressed in the United States, and that's why I think this crisis is far from over.
Thanks, John.
Thanks, Lisa.
Here are the other big stories we're covering this week. Inflation has fallen for the second month in a row, taking the pressure off the Reserve Bank to increase interest rates after its board meeting next week. The monthly CPI indicator released on Wednesday showed annual inflation eased from 7.4% to 6.8% last month. While markets expect the Reserve Bank to keep the cash rate on hold at 3.6%, economists are tipping another increase. And the corporate regulator is investigating the ASX, its directors and officers, for potential breaches of their legal obligations during the failed attempt to replace the CHESS clearing and settlement system. These include a duty to act with care and diligence, to keep the market fully informed, and to not engage in misleading or deceptive conduct. The bungled CHESS replacement project has already cost ASX shareholders $250 million in write-downs. Thank you for listening to The Fin. I'm Lisa Murray with Jonathan Shapiro reporting today. The Fin is produced by Alex Gow and Lap Fan. Fiona Buffini is the executive producer. Our theme is by Alex Gow. If you like the show and want to hear more, follow us wherever you get your podcasts and consider rating and reviewing us as it helps others find us. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. See you next week.
The Australian Financial Review.